Today is January 16, 2024. It's about 9:10 a.m. Eastern. You're looking at a chart of the SPY or spiders. The market was closed yesterday on Martin Luther King Jr. holiday, and the vertical line that you see was the close of Friday, January 12. The 9 levels that are shown here, 6 of them are formula derived levels. The ones that are dotted are more, well, they're important, but they are there for different reasons. So if any trades are taken there, I will be taking a partial position size on those trades. Average in if they continue to the next level. They could work just like the other levels, but like I said, they're not as precise as the levels, the normal levels that are shown with the solid lines. So per usual, we will circle back around at the end of the trading day when the market closes and analyze any trades that were taken at these levels. We'll see you then. Here is a quick look at the price action and the spiders before I remove the non-factor levels which did not get hit and expand the chart a little. As you can see, they hit 3 of the levels from this morning. They did not hit this 476.70, which will be 476.65 when I apply this 5-cent buffer, but I'm leaving it on the chart for a talking point later. The first trade of the day was at 10 o'clock a.m. on the short side when the spiders came back up into 474.37. There was not enough reaction to pull a base hit here, and the spiders continued higher. And the next level that was hit was 475.47, and they got there before a fumble signal developed for the first trade down at 474.37. So another short trade in the E-minis was activated when the spiders hit 475.47, and they didn't react here either. So now the trade was getting into the zone. There was a combined position here, and it was getting into the zone of my maximum loss threshold, which for my account is currently 20 ES points. And that threshold will vary depending on account size, risk tolerance, and number of ES contracts that you trade at each level. And it's at this point where the decision needs to be made whether you want to close out the trade for a loss or to wait it out longer. And the main reason why you would let out the leash a little farther is if you have another level that the spiders are approaching. Because if the spiders haven't met resistance at 2 consecutive levels, the likelihood is increased that the final destination will be a subsequent level if the spiders get there. And for today, this 476.65 level was the safety net. You need to look at subsequent levels as more reasons that resistance in this case would be met. They did not just run up there quickly and hit this level for reaction in the other direction. Instead, they stalled out before they got to the level. In the meantime, a fumble signal had developed, and it happened to be exactly at my threshold of 20 points. They had pulled back a little, and a reversal from the fumble had enough room to provide a base hit, assuming they did get up to the 476.65 level for another short. So that's where the chance was taken, and it paid off. Reversal did give back a quick base hit, which removed some of the sting from the fumble, but unfortunately they never got up here for a new fresh short trade because that would have worked very well because the spiders fell away. But here's an interesting twist. So where the combined position was, that was where it fumbled from the midpoint between the two calculated levels. So that price, the average entry point in the spiders, is the actual level from which the trade fumbled. And per the rules of this strategy, if there is a fumble at a level, and in this case it was at 474.92, then the spiders, it was actually also an important retracement area here. I'll just point that out. So there's an opportunity to recycle this level at the 474.92 if and when the spiders would come back into it. And they fell away pretty fast and came down into it around 11 a.m. And they bounced there quickly, and that provided another quick base hit. From there, now at this point, all the levels that had been hit at this point in the day were off the table for the rest of the trading session. And it wasn't until the spiders came down into 473.36 later in the day that another opportunity presented itself. And as you can see, that was a typical base hit right from the calculated levels. So after that, there were no other levels that the spiders hit. I'll briefly explain the data that has been entered into the log. The first short trade was at the 474.42 level. They continued higher. They triggered another short at 475.52. So this combined entry point created a new level, and that was where the fumble was triggered. So the morning started with a negative 20 points, 20 ES points on the combined position. And the reversal from there provided a base hit of 8 points on the combined position. And on the recycle of that new level, another base hit of 4 points. And then the final trade of the day was just a standard everyday base hit for the last 4 points. So basically, the rest of the day after the first big fumble was laundry day, just washing out the stains. It did help. The net result was ending the day in the red. It happens around 21, 22% of the time, so no big deal. There will be more trades later. But that's a wrap for today. If you find this video and these videos interesting and helpful, consider leaving a comment, question, or let me know your thoughts. And please like and subscribe if you're so inclined. That will help the channel gain traction. Thanks and have a great day.